We have Gabriela Santos, JP Morgan Asset Management, Global Market Strategist, and Jeff Carbone, Cornerstone Wealth Managing Partner. Gabriela, first to you, just the gains that we're seeing today, a lot of this coming on the heels of the news that we got out from President Biden of an infrastructure deal. How are you looking at that in terms of what this means for equities?
Sure. So I think we were starting the day on a positive territory anyway, just unwinding some of that Fed-related down note we had last week, which was just not warranted by fundamentals. And then certainly I think we did add some momentum here with the news of an infrastructure agreement. The way we're thinking about it is it has the positive side of the deal in terms of the equity market perspective, more spending on physical infrastructure, electric vehicles, 5G and broadband, without the tax increases, which would have been a negative from the equity market perspective. This is certainly a positive, especially for the more domestic, cyclical, heavy industry parts of the market, as well as parts of technology like semiconductors, which are more related to the 5G and the green theme.
Let's take a look at where things stand. We have just around 45 seconds here until the bell, and you're looking at gains across the board of the major averages. Again, the Dow up just over 300 points. Biggest leaders in the Dow today, Boeing, Caterpillar, and Goldman Sachs. S&P and NASDAQ both headed for a record here. The S&P hitting an intraday record earlier, and the NASDAQ, this will be another record for this week. Taking a look at the sector action, 10 of the 11 sectors are posting gains today. Financial by far the leader, up just around 1.3% when you take a look at the XLF. Communication services also up just around 0.8%, as well as industrials.
And there is Bright Health Group with the gavel. It is over, kid. Jeff, I want to kick this over to you. I read your notes, and I find this pretty interesting. You're talking about a Dr. Jekyll and Mr. Hyde market right now, and that's potentially because we have kind of a news vacuum going into second quarter earnings. That's in about, 3-4 weeks. What are you seeing in the market right now? Because we've seen growth kind of overtake the value and cyclical trade over roughly the last month.
Well, like you said, we call it that Dr. Jekyll, Mr. Hyde type of market, because last week or 10 days ago, it was more Mr. Hyde was showing up and the markets were correct. And then we go into Friday, last Friday, and we had a nice positive close with I think we were over 500 and the markets gaining those gains with the believe for the month now, and Nasdaq's going to be positive. So we're seeing cyclical trade still has some legs to it, and we're still overweighting the industrials, financials, technology. However, we're taking some of that exposure down a bit. We're raising a little bit of cash, and our theme right now is all about quality, bigger names, bigger quality companies. We're inching our way back in a little bit more on healthcare, just really about barbelling, because we've got to recognize there's a disconnect between the hot inflation data and really treasury yields and the Fed right now. So it's maybe a little bit of time to take a breather. Don't think we're going to see a correction or a pullback right now, but won't be surprised if we see one in the coming weeks.
Jeff, what do you think is the reason there for that mismatch that you just mentioned between the inflation data that we've gotten out and the 10-year yield?
Well, I think some of it is coming from the Fed, right? The amount of think about the amount of fiscal and monetary stimulus that we've had over the last year or so. Almost probably close to $10 trillion has been put out. Even as we see, can the payroll increase or overcome some of that stimulus? Inflation, factors. It's just a lot of money out there. Fed reaction is going to be key, and I know all analysts are all waiting to see how the Fed reacts. We had that from the dot plot in the recent meeting. We're seeing a little bit of some forecasts and some Fed members seeing hotter inflation numbers than others. So those emergency measures that were needed to do the bond buying, bringing rates down to zero. We may have to wane those off, although it doesn't mean we're going to see rates go up. We could starting to see the tapering talk come out, and we may see a little bit of a taper tantrum for a little while. Don't know how long or when, but won't be surprised if we see it here in, like I said, in the coming months maybe, but may see a rally back into year end. So it's about balance in our portfolios for our clients right now.
Gabriela, I want to get your take on the growth versus the value trade. We just heard a great discussion about interest rates, and I always like to get your take on the 10-year, but also the 5-year, because we really saw the yield on the 5-year shoot up not only last Wednesday, but also a little bit today on the infrastructure news. Not so much action in the 10-year, and right now you're looking at the 5-year chart of 3 months. That goes back 3 months, and here's the 10-year, and you can see it's a much more muted reaction.
So I think the 5-year is still an area of the curve where it's very much impacted by expectations of what the Fed is going to do this rate hike cycle. And I do think what we heard from the Fed last week was not a change in their reaction function. They're still, very careful, very reactive, but they just mark to market their expectations. And the data's been good. The economy is doing really, really well, and employment's coming down as well. And inflation has been a little bit tilted to the upside. So you did see investors price in a slightly faster rate hike path, which we see reflected in the 5-year. In terms of the 10-year, look no further for a completely distorted market by technicals. I don't think we can look at the 10-year and get any conclusions about actual fundamentals. It's still being incredibly weighed down by the Fed purchases of $80 billion of treasuries a month. And I do think that is slowly an anchor that will be weaned off. Perhaps at the Jackson Hole meeting, an announcement about tapering beginning early next year. And then you should see the 10-year slowly drift higher, closer to what's actually a logical sense for the 10-year, hence a steeper curve going forward.
Gabriela, let's circle back to what we started with here, the infrastructure talks, the fact that we have this deal now with a group of bipartisan senators. There's still, though, questions about what will be approved here going forward. How much of this do you think has been priced into the market so far?
So I do think the positive sides of the infrastructure discussions are what are being priced in. Leading into this a little bit as well as part of the cyclical recovery trade and things like industrials, materials, and energy. You've also seen it reflected in electric vehicles and clean energy plays, as well as semiconductors. What's still not priced in, I would say, is the more negative aspects related to higher taxes, higher corporate taxes or higher capital gains taxes. That's something that is not reflected in earnings expectations or multiples. So that's something that can cause a little bit more chop over the summer if indeed it becomes a part of a more partisan bill that's expected to pass through reconciliation measures. So that could be something that leads to some short-term chop, nothing that disrupts the overall upward trend, but something that could cause some normal volatility in months ahead.
Jeff, what are some of the themes that you're focusing on here as we enter the second half of the year that may have changed here from just what we were seeing a couple months ago?
Yes, I think, again, like we're all saying, the cyclical trade is still on, that reopening, getting back to normal still on. So still really looking at sectors. And we also mentioned the infrastructure plan, right? So industrials still should do well. Financials, we like regional financials more. So we're really looking at more regional banks, or if you go towards a sector fund, a ETF, maybe with a regional tilt. We're also starting to move a little bit more back into healthcare, add some energy. Well, we've had energy predominantly from October, but really still in those growth. But again, trying to back towards a little bit more of those value trades, looking towards a little bit of communication again, not heavily on staples, but maybe some good quality names if we can come across them. But it's a barbell for us right now. It's that growth and value, where earlier and most of 2021 for our portfolios has been that growth tilt. We're bringing back in a little bit more value as we see some opportunities for out there and what's happening. And when we look at our investment process, if we simplify it back down to, are things growing or are they falling, and what's happening with inflation? We're seeing the growth still out there, but won't be surprised if we see growth come off of into the third quarter, come down. We've had some amazing runs, and second quarter is going to, whether it be earnings or the GDP reading is going to be probably year over year change is going to be probably biggest we've ever seen. So that growth tilt may change and wane a little bit third quarter, and maybe change back in the fourth quarter again.
Jeff Carbone, Cornerstone Wealth Managing Partner, and Gabriela Santos, JP Morgan Asset Management Global Market Strategist. Thanks to you both for joining us.